I'm going to throw a couple of questions in here. John Robert has a question.
So it says here, Robert, what about buying an option at the strike price of the stock's target price? So a stock is trading at 20. That's definitely a strategy a lot of traders use. But again, what you're essentially doing is it's almost like a gamble. You're buying an out of the money call with the idea that it's going to reach that target. So a lot of traders do that, but I'm not a big fan of that for a couple of reasons. Number one, you have a lower probability trade, which I don't like. That's number one. And number two, the time is not on your side, and you have to be perfectly correct in order to succeed in a trade like that. I like being right and making money most of the time. That's like the main difference. When you pick an at the money strike, for instance, you're picking the strike price that has the highest possibility of benefiting from vega or volatility. So the stock price, the at the money strike price has the highest vega, which you want when you want an acceleration of stock price movement. So I'm a big fan of at the money. I know a lot of traders like to play around with picking a target and using that as their strike price. Not a fan, only because it's a lower probability trade.
That's interesting. Okay. It's so interesting when you start getting into deeper into becoming a trader. When we all first start trading, whether it's stocks or options, we're like, we just want to make money. But then as you gain more experience, the focus now shifts more to consistency and the likelihood of making money, or as you're wording it there, probability. I think it's very interesting. You can actually, and this is nothing on Robert, that was a great question, but you can always tell where somebody is in their trader journey based on the question. Are they talking about risk first, or are they talking about making money first? Are they talking about probability or how much they could make? It's fun to do that, because then you can easily not have a rebuttal to that, but just give a different perspective like you just did.
The upside to what Robert suggested, right? If you're perfectly correct, if it actually reaches that target in the allotted time that you choose, right, you're going to make a lot of money, or because you'll probably be able to afford more contracts. So that's the upside. So it's a low probability, high reward, high risk trade. And if you're okay with that's on you. Me, I'm a horseshoes and hand grenades kind of guy. That's just my style.